You've heard it a million times, right? Bitcoin is digital gold. But what does that actually mean? Is it really a shield for your money when everything else is getting more expensive? That's the big question we're diving into today. Can Bitcoin actually protect you from inflation? Let's get into it. Okay, so let's just start with this one kind of wild idea. What if money couldn't just be printed? Like, at all? Imagine a world where no government, no central bank could just create more of it out of thin air. If you can wrap your head around that one concept, you're pretty much on your way to understanding the entire reason Bitcoin was even created. So before we talk about Bitcoin as the solution, we really need to get a handle on the problem it's trying to solve. And here's the crazy part. The money in your wallet, the money in your bank account, it's pretty much designed to lose its value over time. Yeah, really. Let's break down exactly why that happens. So, the kind of money we all use, dollars, euros, you name it, it has a name. It's called fiat currency. And what that means is its value isn't backed by something physical, like a vault full of gold. Nope. Its value comes purely from our trust in the government that prints it. And a really key part of this system is that central banks can, and do, increase how much money is out there, usually to try and steer the economy. And that flexibility, well, it leads to a pretty predictable chain reaction. When governments decide to create a bunch more money, the total amount of money in circulation, well, it goes up. But think about it. If the number of things we can buy with that money, cars, food, houses, stays roughly the same, what happens? Each dollar is suddenly worth a little bit less. It's like the whole pie is the same size, but now there are more slices. Your slice just got smaller. And that right there is inflation. It's the reason you look at your grocery bill and think, wait, wasn't this cheaper last year? It's why filling up your car costs more. It's not always because the stuff itself is getting better or more valuable. A lot of the time, it's just that the dollar you're using to buy that stuff is slowly, quietly losing its power. Okay, so that's the problem. And this is exactly where Bitcoin comes into the picture. It was built from the ground up to be the total opposite of the money we're used to. Its rules aren't decided in a boardroom or by a government committee. They're set in stone by pure mathematics. Take a look at this number, 21 million. Seriously, this might just be the most important number in all of crypto. Why? Because that's it. There will only ever be 21 million Bitcoin, period. That's not a policy, it's not a guideline, it's hard-coded into its DNA. No president, no CEO, no central banker can ever change that number. And this really lays it all out, doesn't it? On one hand, you've got the US dollar, unlimited supply, controlled by people. On the other hand, Bitcoin, a hard cap of 21 million, controlled by code. This whole concept, this idea of provable scarcity in a digital world, that's the entire bedrock of the argument for Bitcoin as a way to store your wealth. And it gets even more interesting. The scarcity isn't just a final number. It's built right into the system's schedule. See, it's not just that the supply is capped. The speed at which new Bitcoin get created is programmed to slow down over time. About every 4 years, there's this thing called the halving, where the reward for creating new coins gets cut in half. So Bitcoin becomes more and more rare on a predictable timeline. It's the literal opposite of how regular money works. Okay, so now that we've established this whole idea of built-in scarcity, we can really tackle that digital gold nickname. When people in finance talk about a hedge, they're basically talking about an insurance policy. It's something you own to protect you if something else goes wrong, like, say, your cash losing its value. Let's dig into why some people are convinced Bitcoin is the ultimate insurance policy for the digital age. This is such a great way to look at it. I mean, for centuries, gold has been the go-to safe haven, right? Why? Because it's rare and no single country controls it. Bitcoin is basically trying to be the 21st century version of that. Instead of physical rarity, it has mathematical scarcity. Instead of being just global, it lives on a decentralized global network. And here's the kicker. Unlike a heavy bar of gold, you can send Bitcoin anywhere in the world, instantly. It's weightless. So when you boil it all down, the whole argument for Bitcoin being a hedge really stands on these three legs. First, you've got that digital scarcity that can't be messed with. Second, it's totally independent from any one country's politics or economic screw-ups. And third, you can move it around with a speed and ease that a gold bar could only dream of. Okay, so the theory is pretty powerful, right? It makes a lot of sense on paper. But we have to be honest and look at what happens in the real world. And this is where the story gets a whole lot messier. Because how Bitcoin actually behaves in the market is way more complicated than the theory suggests. And yeah, here's the elephant in the room: volatility. A good hedge is supposed to be stable, a calm port in a storm. Bitcoin? It's not that. Its price can go on an absolute roller coaster in a single day. I mean, just look at this. A normal day for Bitcoin can have price swings that make the stock market look totally tame. That's a pretty shaky insurance policy if you need it tomorrow. And here's the really weird part. When things get genuinely scary in the markets, like during a big crash, you'd think people would run to their digital gold, right? Well, a lot of the time, the exact opposite happens. Investors see it as a risky asset, just like a speculative tech stock. So when they get scared, they sell off their riskiest stuff first, and that includes Bitcoin. So it often crashes right alongside the stock market, which is not what a safe haven is supposed to do. So you might be thinking, okay, if it's such a bad hedge in a crisis, then what's the point? Well, the people who truly believe in it would say that we're looking at it all wrong. They argue that focusing on what it does day to day or month to month totally misses the bigger picture. The real story, they say, plays out over decades. The bet on Bitcoin isn't that it's going to protect you from this month's inflation numbers. It's not a short-term trade. The real bet is a long-term one. It's a belief that over 5, 10, even 20 years, an asset with a fixed mathematical supply is going to beat an asset with an infinite supply that's always being watered down. It's a bet on math over policy. And really, that brings us right back to the core question, the one at the very heart of this whole thing. When you look out into the future, a really uncertain future, which system do you trust more to protect your savings? The decisions made by human institutions, which are flexible but can be unpredictable, or the cold, hard, unchangeable certainty of computer code? How you answer that question, well, that probably determines what you think about the future of digital gold.